Crypto Hotep here with another investing video. We're on week 93 of the family portfolio in dividends tracker. Thank you again, guys, for tuning in. I really appreciate it. As always, guys, if this is your first time watching this video, first and foremost, thank you. Go to the channel, go to week number 1, and then that way you can get my whole thought process behind these videos and why I'm doing these videos and these updates every single week. But again, if these videos resonate with you, please like, subscribe, comment, reshare this video, comment, let us know what you're investing in. And basically, these videos are to follow the investment journey with me and my family. Okay. I shortlisted a bunch of stocks for them to choose from. They chose several stocks that most resonated with them. And then we use M1 Finance, you'll see it shortly here, as our broker of choice, because it's just easier with M1 Finance. And then every week we go through this portfolio. We've been going through it for 93 weeks now. 93 weeks that we've been documenting this on YouTube, and we're just trying to stay consistent with it. This account started with about $175. Okay, so just keep that number in mind when we go into this. But before we do, this is not financial advice. Please do your own due diligence, investing and trading and stocks and crypto, metals, all that. But before we go into it, let's go and let's touch base on the week that just passed and the different market events that have came on, or that have came and went, that may have affected the markets. So again, we like to use AI, so I like to use Grok. And I just asked Grok to give me a quick synopsis on the economic and market events between January 18th through the 23rd, which is today. And then obviously Monday, very little changed because Monday was Martin Luther King Jr. Day. But I will say this, S&P 500 did close up to around 7,000 this week, which is tremendous feat by the S&P 500. Some of the big events that did happen was tariff tensions eased. So basically, Trump actually took a step back on those tariffs that he was going to impose to the European Union. So a lot of people on Twitter or X, whatever you want to call it, have really called Trump's playbook. Basically, what happens is Trump makes a big fuss on something, he threatens with tariffs, the market drops because of it being scared. Smart people will usually buy around these times. Trump in whoever country, what union, whatever it is, has a conversation. Trump leans back on the tariffs. The market joys and everybody's happy, and then the talks on go, and everything basically recycles and starts again. This has literally happened with multiple countries. And to Trump's point, he's using the tariffs as a bargaining chip to basically get what he wants. And for this deal, Trump wanted or wants Greenland. So he wants country Greenland, and he wants to acquire this company and have this country and have U.S. Basically place their mark onto Greenland and be able to operate in Greenland and use its mineral and land resources as well. So they have some sort of framework, quote unquote, that is going on with Greenland in the U.S. A lot of people thought that this couldn't be done, but it currently is being done. And with Trump withdrawing the tariffs from Europe, the markets definitely love that, and that's why you saw the big jump in the markets. Venezuelan oil control, I believe this was the week that U.S. also garnered about 50 million barrels of oil from Venezuela as well. There's ongoing Fed DOJ probe into Powell and the Fed, so that's still ongoing currently. We'll see what's going to happen maybe next week with that. That could be a little bit more volatile to the downside just because of the uncertainty. And then Davos, the conference Davos, carried on throughout the whole week. You know, obviously you had the presidents, you had President Trump there. You also had a lot of tech-heavy people there. CEO of NVIDIA, right? Elon Musk, CEO of Tesla. So a lot of noteworthy people were there, and a lot of good things that have been going on, and you know, just discussions on global growth. AI was huge for obvious reasons, but really no dramatic, you know, announcements. So, but it was good. It was good, obviously, for that Davos conference to go on and to carry on, you know, as always. Inflation data. Remember, U.S. we had our CPI, or our inflation data, last week. This week it was Euros term. Nothing really, for me personally, I don't really look at Euros CPI like that. So nothing really from the inflation data, nothing really stuck out to me. What did stick out was the U.S. data. I usually focus on the U.S. data, and the Q3 2025 GDP actually reported higher, 4.4 annualized growth rate, beating the expectations. So the GDP is America's economy. It grew in Q3 2025 higher, past 4.4%, beating its expectations. In addition to that, those initial jobless claims that we track on a weekly basis reported at 200K, which was definitely lower, which is bullish. And so, yeah, that's about it in terms of what's been going on in the markets here. So now, before we go to week 93, we always go back to week 92. And week 92 saw the family portfolio with a balance of $3,953.33, a money-weighted rate of return year-to-date of 2.62%, dividends earned of 87 cents, and then a market gain of $99.09. So what happened this week? For week 93, we've cracked $4,000. So we're at $4,020.89, new milestone. We love to see it. We're just chugging along here. That's a money-weighted rate of return year-to-date of over 3% now, at 3.08%. Dividends earned a little boosted at $1.14, and then market gain of $116.68. Tremendous job from the family portfolio. So one of the reasons why that balance did have a slight uptick was this is a deposit week. So it is a deposit week. And so what does that mean exactly? Last week was a deposit week as well, because we were blessed with another payout or payment that we could put towards our investments. And then this week, we were also blessed with a payout as well that we used. So we were blessed with another bonus payout from my job, and we put a little bit of money in the markets here. Put about $50 in, and we had M1 Finance divvy it up for us. And we bought some Coca-Cola, Amazon, Microsoft, Tesla, Domino's Pizza, Sony, and Apple. All good companies, all good names, all good buys right there. Okay, so let's go to the portfolio bottom to top now. At the bottom is our middle, but as I've said before, like last week, our middle, despite the balance, the year-to-date return is the best return out of anybody. So our year-to-date return for our middle is 6.7%, with a balance of $562.75, market gain of $34.40, no dividends earned as of yet. But if we look at it, almost everything is in the green here. Sony has taken a little time off. We're not too worried about that, right? Down over 9% year-to-date. That's okay. That is completely okay. You got to be willing to ride the highs and the lows of the companies that you're investing in, especially if they're companies that you feel very strongly about, or the ones that you've done the research, key point, done the research on. You should be completely fine with these companies dipping and giving you a discount. Tesla, we're up a little bit over 0.06%. Starbucks doing its thing. As I said before, last year, up over almost 16% on Starbucks. Google up almost 5%, Amazon up over 3.5%, Costco. If you remember, 3-4 weeks ago, I said, watch out for Costco. It's going to do what Costco does, and it's up over 14%. Target up over 10%. I did mention 2026 might be Target's year, so it's looking like that right now. We'll see. Let's go to our youngest. Our youngest has a balance of $570.96, money weighted rate of return year to date of 2.16%, market gain of $11.76. And Starbucks is holding its own for this portfolio as well as Costco. So you're kind of seeing a theme here, as we mentioned. Tesla, we are down a little bit on Tesla, not worried about that at all, I should say. Sony down over 9%, very similar to our middle. And then Apple, we are down over 8%. Now, Apple, as a reminder, we mentioned that Apple probably would hit its peak at the beginning of the year and start trending down. Then when all the FUD comes out, because it's going to come out, Apple's down over 8%, or we're down on Apple over 8% year to date, there's going to be some headlines about Apple, right? I mean, one of the headlines now was Tim Cook is not stepping down as CEO, and he wants to continue being the CEO of Apple. I don't blame him, honestly. But don't be concerned with the dip that you're going to get with Apple. Again, don't be concerned with that dip. Okay, let's go to, and with our youngest and our middle, two great portfolios. I mean, honestly, the whole family portfolio is all in the green. Nothing bad to say at all. Let's go to my wife's portfolio. My wife cracked 600, so at 609.44, money weighted rate of return of 5.2%, so also a very, very good return. Market gain of $29.39. The big heavy hitters we have are Celsius. Again, this might be Celsius's year again. Last year it was. I think we closed above 50%, or my wife did, on 50% on the Celsius position. We're up over 22% year to date on Celsius already. That's amazing. But again, the Celsius position for my wife is one of those reasons where you buy when it's low and you buy when it's high. Again, if you have a conviction about a company, just keep buying the company and just have time. Time in the markets beats timing the market every time. Pepsi in the green here, almost up about 1%, and then Google up almost 5% here. Tesla down, very similar to everybody else's, not worried about it. And then Microsoft, that position we're still building up, down over 2.5%. Again, watch out for Microsoft and Apple, because those two, they're tech-heavy companies, but they're dipping, which they should be based on technical fundamentals, or technical analysis, I should say, and fundamentals. Those two companies are dipping as prescribed, and they're providing a nice buying opportunity. Not financial advice at all. Let's go to our oldest. Our oldest cracked 1,100, so $1,116.79, up over 1% year to date. No dividends earned. Market gain of $11.77. Currently down on Apple. Again, very similar to the others. But Costco up over 14%. You see how that trend's going? McDonald's up over 1%. And then Tesla, very similar to everybody else, down a little bit over 0.15%. Not really worried about this at all. This portfolio, one of the most simple portfolios that is in the family stock portfolio. Watch out for this one. I'm telling you right now, you got the heavy hitters here, and you have a good anchor, as in McDonald's, just because it's a dividend stock. It's been around for decades, not really doing anything, not really going anywhere. You have the volatility of Tesla, you have the certainty of Costco, and then you have the tech of Apple. So watch out for this. And then last but not least, it's my portfolio. So my portfolio, we have a balance of $1,160.95. Money weighted rate of return year to date of 2.73%, so not bad. Market gain of $29.36, and then dividends earned of $1.14. Here we have technology. The technology portfolio consists of Microsoft and Google. We keep it very simple. As with the others, Microsoft is down, completely fine, but Google is doing its thing, so it evens out somewhat. Okay. With finance, we have Visa and we have Moody's. Okay, Visa is dipping. Visa dipped because of President Trump's proposed cap on interest rates on credit cards. Completely fine with me. I'll buy Visa at a discount all day long. Visa is a compounding machine in terms of dividends and price appreciation. I will buy that all day. Industrials and energy, we're up a little bit over 3.5%, with, again, very stable names. Waste management, trash ain't going anywhere. And Cintas is a sleeper for dividend payouts. They've been very consistent over 3 decades. You can't beat them. Real estate, we all know that's O. I'm going to stay with O. That is my income driver. Consumer staples, I should say, is Costco. We talked about that. And Lowe's. Lowe's was down Q4 of last year. And guess what? We're reversing back, up over 15% this year. Let's go. Okay. Restaurants and food, we have Domino's Pizza, and then we have Coca-Cola, which is the GOAT here. And we bought some more Coca-Cola. So we bought some more. We added to that position here. And then pharmaceutical is just AbbVie. AbbVie's just taking a break this year. So we may see a reversal with AbbVie towards the middle of the year or so. Again, AbbVie is a dividend compounder as well. Not really worried about this. This is a trusted name, trusted brand, trusted company. Okay. So all in all, with my portfolio, I'm liking my portfolio. You want to see up and to the right, and that's what it's doing. I don't have the big gains of our middle or my wife's portfolio that's in the 5%. But again, for year-to-date percentage, over 2.5% already in the year is pretty good. So with that being said, guys, we will cut this short. So week 93, it saw the family portfolio with a balance of $4,020.89. Money weighted rate of return year to date of over 3% already, 3.08%. Market gain of $116.68, and dividends earned of $1.14. If this video was helpful, guys, feel free to like, subscribe, comment. There's some people that have been watching these videos since day one, and I really appreciate that support. I think I got a comment on the last video. We'll just hop right here. Right here, investing for fun. Been watching since day one. I really appreciate that a lot. I can't, it makes me feel good that somebody else is also watching the video and maybe they're getting something out of it, as well as me making these videos for my family as well. So it feels good that, we can. So as always, guys, thank you and happy trading and investing.